Hello out there, dividend growth stock investors. Colby here, the DGI Crab, wishing you a happy Sunday. Back again for the weekly video where I break down each of the four tiers to see where the undervalued stocks in the market lie. If you're new to the channel, this is an age-based dividend growth stock investing strategy channel where the age and time horizon of the investor is the most important metric to keep in mind. I cover 60 high-quality dividend growth stocks split into four separate tiers based on the age of the investor, where I believe that the younger you are, the low yield, super high growth stuff is the area of emphasis to focus on, and the older you get, the higher starting yield and the slower but more stable growth becomes the goal. Regardless of what your age is, investor, consistency is key when it comes to dividend growth stock investing. It is not always the most exciting or the most sexy way to invest, and it can feel, especially in your first few years, like it's just going to take forever in order to reach financial freedom with dividends. But what I'll urge you all to do is not take any shortcuts. Stick to a strategy, stick to blue chips and ETFs, and you will get there. There's a common refrain that says that the first $100,000 of investment is far and away the most difficult goal to achieve. And then the second 100,000 is quite a bit easier. And the third 100,000, even easier than that. So hang in there, whether you've got 100,000, a million, 10,000, or you're just starting out. You've just got a few $100 invested and you're trying to get your feet wet and see what this dividend growth stock investing game is all about. Hang in there, be consistent, and don't sacrifice quality. So, I am not a professional financial advisor, so the content of the channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. And for the newbies out there, if you're tried and true DGI crabber here, you feel free to skip past this, but I will just explain to everyone out there that might be seeing this for the first time that my personal strategy is as follows. I put a minimum of 50% of my invested dollars each week into age-appropriate ETFs for automatic diversification. And then for the single stocks, I am looking for the stocks that are yielding at least 30% or more above their 4-year average yield. Now, I do have a top 10 favorite stock list. That is just my personal preference. If any of those stocks hit the 20% or more above their 4-year average yield mark, I will go ahead and invest in those regardless of my age, because I want to make sure that I have strong positions in all 10 of those. Now, I remain within my age tier unless there is a stock in a different tier yielding 50% or more above the 4-year average yield. It's just too big of a bargain to pass up at that point in time, in my opinion. And if there don't happen to be any good viable stocks within my age tier in a given week, I don't invest less. I just simply put everything for that week into ETFs. So that way I know for sure that I'm going to continue to increase my passive income. So what I thought I'd do first before we jump into the age tiers is let's just take a quick look at the S&P 500. This is Vanguard's VOO S&P 500. And over the past week, we've seen a little bit of a downturn in the market. It's down a little over 1% on the week. And if we zoom out to the past month, we're basically just kind of trading flat right now, down 0.78% over the course of the last month. I think there's still just a certain amount of adjustments that are being made to the new Trump administration. There's been a lot of talk of tariffs and new policies and all these different things. And I just think that whether it's Trump or any new president, there's just going to be a certain amount of time for the market to kind of figure out what that new administration is going to do, how that's going to affect different sectors. And the market is way up over the past year, up 17.44% over the last 365 days. We could be potentially entering into correction territory because, really even over the past 5 years, you can see here the market is up 101% over the past 5 years. And that is remarkably good even for the S&P 500, which historically over time averages about 11% on average a year of annual return to investors. So Who knows if the market's going to go up or down? None of us really do. So the name of the game is consistency and sticking to a plan. So my personal plan here is to stick to the tiers. So here we are in tier 1. These are the stocks for the 18 to 30-year-old investor where we're looking for lower starting yield but aggressive overall dividend growth, where we want double-digit cumulative dividend growth year over year out of our stocks. We're sorting these by the valuation tab, where I'm comparing that 4-year average yield to the current day yield. Anything in the green has hit that 30% or more undervalued and is in the buy zone. If it's not in the green, it's not a sell. I don't sell stocks. I just let the dividend reinvestment do its thing. We've got Nike, Nordson, and United Health in the buy zone for the 18 to 30-year-old investors. Still excellent buying opportunities for all three. Nike has gotten back up and near that $80 range, which is kind of nice to see. I'm beginning to get a little bit concerned with Nike's ability to continue to maintain their dividend unless they can start to make some improvements in their sales and their cash flow. I'm not concerned right now that there's going to be a dividend cut, but I would like to see Nike start to turn it around just a little bit. There are plenty of reasons to think that they will do so. They're an internationally recognized brand, and you can still get that starting yield at or above 2%, which is certainly not too bad because the average for this group is less than 1.5%. Nordson, I think, is probably the deal I'm the most excited about in this particular tier. Dividend King. Great history of aggressive dividend increases. That is also in that 50% or more undervalued range. You can get that with a starting yield of 1.48%. And Nordson aggressively grows that dividend historically, so really exciting opportunity there. And United Health, if you haven't been investing in United Health over the past week or so, I think it's still a nice buying opportunity in this particular price range, comfortably below $500 per share. Tier 2, the age 31 to 41-year-old investors. I'm still 41 years old, so I've got a little while left to take advantage of the deals in this tier. Hershey and Target neck and neck for the top two positions. I was thinking last week that Target might actually overtake Hershey in that capacity, but Hershey still has the edge right now, still more than 50% undervalued based on 4-year average compared to current day yield. But Target is right there as well. Both of these stocks well above 3% starting yield. Target with a 3.6% starting yield. This is an age tier where, you're really looking to get like 2.5%, 3% starting yield with hopefully dividend growth in the high single digits. And Hershey and Target definitely presenting those opportunities. And NextEra Energy, really happy that this one is down here at the $70 range. It is in my buy zone. I'm really happy to have an opportunity to continue to add to NextEra Energy. American States Water is right there, 29.99% undervalued. Certainly not a bad deal for American States Water with that starting yield at 2.43%, where the 4-year average is just 1.87. Moving on to tier 3, 42 to 53-year-old investors. Usually starting yield in this age range is in the mid 3s to low 4s. We want to get good solid dividend growth in the 5 to 7% range cumulatively out of these guys. There are only 2 stocks that are in that green buy zone right now, thanks to Genuine Parts Company recovering a bit in share price. It's right there on the brink, but not quite there. Hormel and Archer Daniels Midland, these have been the 2 dogs in this category for quite a while now. The 4-year average yield on both of them continues to very gradually creep up, but if I'm in this age range, I'm very excited to add starting yield above 4% on both of these. And, they're definitely going through it right now. I'm not anticipating a dividend cut out of either of them, so might as well jump in and grab the high starting yield while you can get it. Pepsi, one of my top 10 favorite dividend stocks, is in my buy zone still. Just 26% undervalued, but this is one of those 10 that I only need to see a 20% discount before I jump in and buy it. Very happy to add Pepsi, getting a 3.5% starting yield. Tier 4, 54 and older investors, we want higher starting yield. We're not going to expect great dividend growth at this point in time, but we still want to be steady and consistent, 2 to 4% or so annual dividend growth. These high yielders have not been cheap for quite a long time right now. I don't see any screaming buys in this particular age category right now. And we even got some nice dividend increases out of Realty Income, Prudential Financial. These were Essex Properties, all gave nice dividend increases in the month of February, but they were not enough to make them super undervalued stocks in my estimation. Quick swing by the top 10 tab. So this is my personal top 10 favorite, not new stocks. All of these are contained somewhere between tiers 1 through 3. Pepsi in the buy zone. Everything else is a hold. Johnson & Johnson had a nice recovery after being way down a couple of months ago. I remember being able to add McDonald's last fall when it was down at like $250 a share, and it has recovered brilliantly. And just really still waiting on a lot of these other ones. Wow, Visa is just on an absolute tear, by the way. This one has just absolutely shot up over the past 6 months or so. I always wish that I have a little bit more Visa than what I have, but I'm certainly not going to be adding anything to it when it looks this overvalued. All right, now, everybody, so the strategy for the week for me by tier would be as follows. As I said, 50% at least goes into those age-appropriate ETFs. For the younger investors, I think the S&P 500 should be the primary focus with a nice small-cap value fund paired in there as well. VIG is a very nice dividend appreciation ETF where you could start adding a little bit of money into that at a young age just to sort of get the ball rolling on that. And then VYMI, I do 5% across the board, regardless of age tiers. That is my absolute favorite non-US ETF investment. And I just keep my portfolio at 5% in this higher yielding international investment fund. At tier 2, where I'm at, I switch it around a bit. I do VIG as the primary emphasis, with S&P 500 and small cap still factoring in there, but just at a lesser percentage. Tier 3, I just love SCHD, VYM, and DHS as ETFs in this particular category. You can't argue with the results of SCHD. It's been the best of the three, but all three of them have sort of varying strategies and good track records of price appreciation, dividend increases, and consistency. And then for Tier 4, I like SPYD for the stock exposure, getting the 80 highest yielding stocks in the S&P 500. Straightforward, simple, low expense ratio. Good thing to have some stock exposure there. And you're going to get a nice chunk of real estate with this one as well. And then alternative investments that I typically don't emphasize anyone really focusing in on until they hit their mid-50s and they really need to start adding a lot of high yield stuff now. High yield bonds, SPYI, preferred shares, PFFA, MLPs with MLPX, and then covered call strategies like Devo, JEPQ, and SPYI. Very nice combination of things here that can generate you a lot of dividend income very quickly. Most of these, with the exception of VYMI, MLPX, and SPYD, the rest of them are monthly payers, so that can be really nice as well. Now, for the allocation strategy, if you're in that tier 1, I think that focusing in on what's in your tier first is still key. So Nike, Nordson, United Health, and then Pepsi, because it's a top 10 favorite of mine, I'd be adding a little bit into that. And then Hershey, Archer Daniels Midland, and Hormel all meet that criteria of 50% or more undervalued. So these could all be on your radar as well. For tier 2, it would be Hershey, Target, NextEra Energy for the three in the tier that are undervalued, Pepsi, and then ADM, Nike, Hormel. Tier 3, Pepsi and ADM would get the primary focus for me, and I'd still be hitting Hormel as well. And Nordson, Hershey, and Nike give the tier 3 investors respectable starting yield, and it's still going to give them a lot of dividend growth as well. Now, maybe the closer to 50 you are, the less emphasis you'd put on Nordson or Nike. But man, if you're still in your mid 40s, growth plays are still not a bad idea. You still got time in the market. And then for the tier 4, ETF double down, doubling up on all the ETFs because there's no good deals in my tier, and I would grab some ADM with that extra 5% left over. All right, everybody, what are you buying this week? Let me know.